Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. A possible upside projection that we were looking for the December corn contract was in the range of 353 to 354. After the WASDE report was released, the market actually came down, and only the following day to reverse right back up again. And what we found on Friday is the market continued to the upside, reaching 358 and 3/4. After doing so, the market moved right up to volatility-based resistance, where we see a bit of an overlap. And as we suggested in the past, once the market reaches up into volatility-based resistance and touches that area, we can often see a consolidation that lasts somewhere in the neighborhood of 5 to 7 days. That's what we've been seeing over the last 4 days or so after the market did reach volatility-based resistance. Additionally, we talked about the stochastic formation that had set up, and we thought that we might see that formation reappear again, and we're seeing something very close or very akin to what had established itself in mid-September. As the market comes in right now, the key is to whether or not we're able to get any follow-through up through where we're looking at key resistance. We're looking at about 366.5 is a very important level for this market right now for the balance of this week. But we anticipate a bit more consolidation, and now we're moving into the October 25th timeline for a potential turn point. What we might be looking at then is for the market to move sideways to slightly up into the 25th, at which point we can see maybe one more downdraft before the market's able to really make a significant low and then turn back up post-harvest. One standard deviation below the point of control rests at 327 and 3/4. And you can see the market really had fantastic support against this level here. You go up one level, we're sitting at 377. 377 is well above where the market is right now, but this pattern that we're seeing suggests that we could see a small move to the upside again that could test that 366.5 number we just discussed. For now, we'll continue to watch the market as it plays out, but again, these are some very good levels to perhaps be pricing or to locking in some profits from the move that we've seen from the recent low. The March corn contract is very similar in its formation. What we find here is that key resistance right now sits at 372, not very far from where the market is actually trading. The high from Friday came in at 368 and 1/4. Above 372, we have our next level of key resistance sitting at 381 and 3/4, or about 382. And so those are going to be the two key levels that we would be watching for this market move to the upside. The stochastic, once again, is showing the same pattern as it did before. The key right now is to whether or not this move can continue to have strength or whether or not it's going to perhaps dip back down. We are noticing that volatility-based resistance has started to shift its way to the upside, which indicates that the market may have the capacity to push up just a little bit. We would again be looking at upside resistance near that 382 number, and that should be a very key figure for this contract over the next several weeks. One standard deviation below the point of control sits at 366, and that's essentially where the market has been hovering right now as far as resistance. We move up one level above that, we're sitting at 400, and so 400 is perhaps really the line in the sand for this contract, but that's really a good ways off before reaching there. And so we're more interested in seeing what happens in the intermediate zone, very close to that 382 number we just discussed. Despite the strength in the corn market, soybean has not been as fortunate. As you can see, it remains in the trading range in which it's been in since August. And so given the fact that it remains in this range, its key resistance levels overhead right now are going to be two very important areas for the soybean contract. But in particular, what we notice as well is that the market has come in and is now overbought. And so if the market actually comes in into resistance and falls back down again, we would not be surprised to see the market come back and retest at least one more time that 928 number. And depending on how strong of a move it has going to the downside, if that were to occur at resistance, we could very well see a test of about 900, but that again remains to be seen. But we want to be very careful as the soybean contract has not been nearly as strong as corn has been in the recent days. For quite some time now, the point of control level of 960.5 has been operating very much like a nodal point for this contract. What we mean by a nodal point is that each distance that the market has traveled on either side of this nodal point has been very close to what it's done on either side. So now what we're looking at is for this move that has been very equidistant as he's gone back and forth to really be able to truly break out of this nodal sideways movement. So the sideways trend that we've seen has been consistent for quite some time. And so what we're looking at is soybean needs to break out, and in all likelihood, we're looking for one more downside break before he's able to escape this sideways consolidation, this low volatility period before really being able to trend. The January beans contract finds itself in a very similar pattern as that of the November beans contract. Currently, we're sitting at resistance near 986 3/4. Followed by subsequent resistance at 1018 1/4. That 1018 number is very close to the 1020 number for the November contract, but we also have volatility-based resistance coming in. And so this area of congestion suggests that this Jan contract is going to have some trouble here. And again, we can see that the volatility is really narrowing between the markets. It's been making its way up from volatility down through here, and volatility from the upside has been actually channeling on its way back down. And so once this market comes in and the volatility is actually able to really stop in through here, what we would then be looking at is where the volatility squeeze actually terminates. Then we're going to see a very big explosion out of this market, and that appears to not be that far away, given that it may be near the end of the month or sometime in early or mid-November. For the January contract, what we would be looking for at this time is for him to perhaps pick one of our trend lines to decide to start tracing through. You notice again the market had been sideways, and that sideways movement kind of terminated once he got to our natural existing trend line here. So what we would expect is potentially for the market to maybe trace up against this trend line, or now that you can see he's up against one of the 1x1 lines, if he finds true resistance here to actually trace back down this line, or to make a jump up through the next trend line and perhaps trade down through this trend line if he reaches up against here. If he finds strengths above this number here or above this level, then we're looking at a market that could very well be strong, again, that continues to trace up against this natural trend line as he would make his way through here over time, again, touching this trend line and then being able to mount some strength coming through here. The short of it is we find ourselves in a critical timeline as we approach the end of the month. The December wheat futures contract broke out of the top side of what had been its trading range. We finally got a very nice close above our 180-degree mark, above that 413 number. And in doing so, the market has then reached up, consolidated some, reached back down, has now found support at that 413 number, and has since bounced back up again. Even though the market's overbought right now, if this is a change in trend, what we'd be looking at is the potential for the market to continue remaining overbought for some time, which would in turn suggest that the trend has turned from what has been a long-term downtrend from wheat, and we could very well be converting up into a potential uptrend. At the very least, we've been looking for a cycle move up into the middle of November for wheat, and it appears to be doing just that. We were holding our breath trying to figure out whether or not this move that we had seen has been consolidation or distribution. And by the nature of the move that we're seeing, depending on whether or not 413 is able to hold through the rest of the week, I think we may have our answer that this motion here, or this consolidation here, was in fact accumulation. And in having accumulation, what we're looking then for is some continued movement to the upside, at the very least through the middle of November. Here we find the market again holding that 413 number we just discussed, making a nice reversal on the intraday move today. If the market's able to continue with its strength, we'd be looking for a move to the point of control level at 443.5. And this would be a nice near-term target that we would be looking for this contract before it comes off the board. Lastly, The thing that we're looking at again, similarly, is whether or not the market's able to trace up through this area. And so what we would have is a time and price squaring of the market coming in. If it were to touch that 443 to 443 area around this timeline of late October, then we'd have a perfect square out for short opportunity or to really take some profits off of this up move that we're seeing. Last week, we shared our crude oil projections versus what actually happened. And you can see here that the numbers came in very close to one another, as we discussed last time. Additionally, we suggested that the market, after having made a top on the 10th, that a consolidation was due. And as long as it held support, we could see a potential run up to the upside before coming off the board. We are running out of time for it to do that, but it's nice to see that the market did in fact hold support, coming off of the highs for about 5 to 7 trading days, and then really seeing a nice rally to the upside. The key support that we're looking at is as long as it doesn't break this previous pivot swing high at 49.02, as long as the market stays above here, there technically is a chance that he can make a run for that 60 number that we talked about before. Again, that's still a long ways off, but at the very least, if you took some money off the table here or tightened stops, at least you were able to be profitable off of the move that we're looking for to touch somewhere in the neighborhood of 51 to 52 that we've shared for quite some time. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.